Fortescue Metals chairman Andrew Forrest has been at the centre of a 3-month media storm ever since he uttered his controversial challenge to cap iron ore production in a bid to drive prices back up. But it's now emerged that a debt-laden Fortescue has been courting investment from at least 2 Chinese firms, aiming to shore up its troubled balance sheet and keep the company's expansion on track. Neil Woolridge reports.
He might have lost the battle for an inquiry into the plunging iron ore price, but in a month-long media blitz, Fortescue chairman Andrew Forrest left no doubt who he thought the real villains are.
I've noticed, even from Perth, the amount of energy, the amount of excitement which the multinationals have put into a major lobbying campaign in Canberra. We've got one London-based multinational who appears to look at Australia as a plaything.
But it seems not all multinationals are bad, especially those that could lend the debt-laden Fortescue a helping hand. Already, China's Hunan Vallon has a 14.5% stake in Australia's third biggest iron ore producer, which it bought in 2009. Now it's been revealed that Fortescue has held talks with China's biggest steelmaker, Baosteel, and largest conglomerate, CITIC, about ways to shore up its balance sheet.
It's been a fairly aggressive campaign and a bit perplexing as to what the real agenda is.
Fortescue's destiny is not really in its hands, and that's what I think the real driver of all this kerfuffle is.
While Fortescue has been busily stripping costs out of its business, its $9 billion debt burden and $600 million a year interest bill are red flags to many investors. Despite those risks, investing in Fortescue would offer the Chinese 150 million tonnes a year of seaborne iron ore, more than 10% of the global trade.
They'd want to see that be maintained and have, ideally, an alternate source other than BHP, Rio or Vale, really to just keep them honest and to make sure that there's supply from an additional source.
Whether they get a return on that or not, that's less of the point. It's more about keeping the supply in the market and keeping the iron ore price down.
Despite cutting back on their more ambitious expansion plans, the major iron ore producers like BHP Billiton, Rio Tinto, Vale and Hancock are still adding to global supply. With Chinese demand easing, smaller, higher-cost miners in Australia, South Africa and Brazil are expected to shut down.
If then there are further expansions which still make sense for BHP, Rio, Vale, and they still want to press ahead, then the next part of the market where that's going to come from is Fortescue. So that's really what this is all about.
Hey, how are you? Nice.
But if a Chinese white knight does come to Fortescue's rescue, it would potentially depress iron ore prices for longer, the opposite of what Andrew Forrest was hoping to achieve when he spelled out his controversial iron ore cap proposal at a Chinese dinner in March.
All of us should cap our production now, and we'll find the iron ore price will go straight back up to $70, $80, $90.
Chinese investors have already been badly burned in Australian iron ore. CITIC has suffered a world record $7 billion cost blowout and years of delay on its Sino-Iron joint venture with Clive Palmer. And the $1.4 billion takeover of Aquila Resources by a consortium led by Baosteel last year is not looking so bright, with its joint venture partner Horizon doubting the economics of Aquila's West Pilbara iron ore project.
The alternative of trying to do a win-win deal with someone like Fortescue makes a lot of sense given, relatively recent history in regard to bad investment by China in order to secure supply.
Andrew Forrest says he has no plans to reduce his 33% stake in Fortescue, and last month the company told investors it was unaware of any Foreign Investment Review Board applications by third parties. But that carefully worded statement doesn't rule out the possibility that Fortescue has been discussing either an equity or debt investment with the Chinese. Resources analyst Matthew Hodge says while Fortescue is not in immediate danger of collapse, it lacks diversity, can't compete on cost with BHP and Rio, and has a much weaker balance sheet.
Fortescue was built in a boom and built using debt. It's a single commodity producer. It benefited from the wave of the China boom, and now we don't have a China boom anymore. It's just, this is standard boom and bust.
The real squeeze for Fortescue will come in 2019 when it has to refinance $5 billion in debt. But if iron ore prices stay lower for longer, that too will test the patience and deep pockets of its putative Chinese allies.
Thank you,